Welcome to my channel. I'm the Covered Call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My projected income right now is almost $70,000 a year, almost $6,000 a month, and I'm strictly using Covered Calls ETFs to reach my $120,000 per year goal. And when I do, I'm not sure what to do or what I will do, or maybe increase my goal post to 150,000. I don't know, guys. Leave me a comment what I should do once I reach my goal. I'm open to all suggestions. Before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve substantial risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online, and I could be completely wrong. Okay, with that out the way, today's video is gonna be on return of capital, or ROC. I feel like I needed to make this video because I just feel like a lot of people are uneducated or don't know enough about it. They only know it's giving you your money back and tax advantage or tax deferred, but it's much more than that. If you to actually learn about it, you would be like, oh wow, this is one of the biggest uh, benefits of investing in covered call ETF is the return of capital, right? That return of capital is going to help you snowball for you to create your generational wealth. So today's video is going to be on return of capital, right? The Savvy's Investor's Guide to Return of Capital, a comprehensive analysis for investors in covered call ETFs and estate planning. If you have any goals in having a family for your stocks to be passed down. So I just had that in there because I do. All right, part one, deconstructing return of capital. What is return of capital? We're going to go by definition. We're going to say ROC. Definition: distribution, which is payment not paid from an investor's current or accumulated earnings and profits, EMP. Legal name: for tax purposes, it is officially categorized as a non-dividend distribution. All right. The immediate appeal: it is not considered taxable income in the year it is received. This is quote unquote tax-free cash flow is its primary benefit, right? So we're getting paid out $10,000 a month. Oh baby, if it's ROC, I'm keeping that $10,000. I don't have to pay the IRS. Uncle Sam isn't touching my money. Going straight to the strip club. Nah, just kidding. But it's tax free, right? Tax, quote unquote, tax free, and I put that in quotes because as we're getting it on, it's not really tax free in a sense, right? It is tax deferred. The non-negotiable trade-off: instead of being taxed, the ROC distribution must be used to reduce your adjusted cost basis, right? ACB in the investment. The core misconception: it is that it's just getting my own money back. You see it all the time on YouTubers saying it, or YouTubers or Reddit or on X just trashing, oh, it's just your own money back, right? That is the common assumption that implies the fund is failing, liquidating its assets, or performing poorly. In many contexts, this is a major red flag signaling a loss of your initial investments, right? But we have to look deeper than that, right? We just can't be like, it's your own money back. You're losing out because of the expense ratio. You're paying the managers just to get back your money, right? But the reality in covered call ETF is that it's classified as a strategic tax classification, right? It is deliberate. The ROC is deliberate feature It is a tool to distribute cash flow in the most tax efficient way possible, allowing the investor to defer taxes, right? Often for decades, depending on how much you have invested and your cost basis. So, it's when I say quote unquote tax free, it's delaying your it's you're not paying the taxes now. You're just pushing it back for when your cost basis goes to zero, right? ROC versus return on capital, right? ROIC. ROC is a tax classification for cash distribution. Return on capital is a performance metric measuring profitability. And then a question answered: how is my cash distribution classified for taxes versus how much profit is my investing earning? Immediate tax impact for ROC, non-taxable upon receipt. And then for return on capital, taxable as income or capital gains. Impact on cost basis, reduces the adjusted cost basis versus no direct impact on cost basis. And then common example, non-dividend distribution from a covered call ETF versus qualified dividends or interest income. So understand the difference between these two. It's not the same. Good ROC versus bad ROC, right? We have to look at the ROC framework, right? That's when they say, oh, it's just giving you your money back. Well, is it good ROC or bad? Destructive bad ROC, an economic problem, the fund total return is less than its distribution, is liquidating itself, right? The NAV erosion to make the payment, where your total return completely gets destroyed because you're distributing more than you're actually earning, right? The NAV starts at 10, that's where you buy it. The fund pays $1. As ROC, the NAV drops to $9, right? The $1 was paid by selling itself, liquidating itself. Now, here's the constructive good ROC, right? It's a tax strategy the fund actually uses efficiently, right? The fund's total return exceeds its distribution. It uses tax loss harvesting to classify the payout as ROC, right? The total return is greater than what is paying out. The example, the fund is profitable, the NAV is stable or growing, the stock price, that's what NAV is, but offset gains with losses, driving taxable E&P earnings to zero, right? The cash payout is forced to be ROC. That's what we want to see. That's the covered call ETFs we want. Part 2, the mechanics of ROC and covered call ETFs, right? How covered call ETFs generate cash. Step 1, they buy the stock. The fund first buys a portfolio of underlying stocks, example SP500. Step 2, sell options. The manager then sells or writes call options on the same stocks. Step 3, collect the premiums, the cash. In exchange for selling options, the fund receives immediate cash known as option premium. Trade-off. The fund's primary goal is to earn high income. In exchange, it gives up the potential for capital appreciation above the option strike price. So please understand, covered call ETFs are not growth stock. You are not going to see that 10x or the 5x or you know, whatever crazy 20 bagger you're trying to achieve. But what we will receive is that big bagger in income every month or weekly. The regulatory and tax engine. Why ROC is necessary. Problem 1, tax law. Cash from option premium is not investment income like dividends. For tax purposes, it is treated as a short-term capital gains. Problem 2, SEC rules. Investors demand monthly payout, but SEC rules like 19B-1 prohibits fund from distributing capital gains more than once or twice per year. Solution, ROC. ROC is the bridge. The fund pays cash monthly at the year end. This is cash in excess of taxable EMP is legally classified as ROC, solving the conflict. So ROC is the tax loophole, right? It's not a loophole, but it's there for like, okay, why not use it to attract investors, right? It's part of the way to attract investors, and we pay you out tax deferred, quote unquote tax free, invest in our fund, right? We do well, it's a win-win situation. Fund strategy: actively manufacturing ROC. Primary tool: tax loss harvesting. Managers intentionally sell losing positions to offset realized gains from stocks or premiums. The goal of this strategy drives the fund's net taxable earnings and profits down to zero. The advantage: loss carry forward. ETFs can bank these losses indefinitely, deploying them in future profitable years to ensure a continuous stream of ROC. The benefit: this enhances the fund's tax efficiency, deferring the tax bill for the shareholders. How to identify ROC estimate versus final word, right? So your fund might on the website might put out section 19A-1 notice. It is sent during the year, but it is always an estimate, and I personally would not even care about those because they can be way off. They can be completely like I have here, highly inaccurate. I mean, it could be telling you 100%, but by the time you have the final word, the 1099, it could be like, oh, this year was only 60% or 70%. So you should always treat, this is what I do, always treat your monthly payouts like if it was a check, right? Put aside for taxes, right? So for Form 1099 div sent after the tax year ends, the official final ROC amount is listed in box 3, non-dividend distribution. So that is actually what you might possibly owe or not owe, right? And then not all ETFs are equal. Fund selection is critical. Some funds like JEPI uses structures like ELNs that may result in distribution being taxed as ordinary income, not ROC. Part 3, the investor's tax journey. Right, so the immediate benefit is that it is tax deferred as tax deferred cash flow. The tax-free, quote unquote tax-free distribution, if you get paid out at $1,000 classified as ROC, means zero is paid in income tax for the current year. This provides a tangible boost to net cash flow. This is especially valuable for retirees as it does not add to adjusted gross income, which impact Medicare premiums or benefit thresholds, which is what I need and what I love, because if I don't meet the criteria to apply for Medicare, right, as a early 30-year-old, I might not be able to. I want to show that I'm broke. I don't have no money. I want government subsidies. The core mechanism: reducing your cost basis, right? So the non-negotiable trade-off: ROC is not taxed now because it reduces your adjusted cost basis. You are systematically creating a potential or embedded capital gain that will be taxed later. So new adjusted cost basis equals original cost minus total ROC received. So you're able to always, you should be able to see that in your brokerage too, right? So it's tax deferred, and it doesn't mean you never pay the tax, but once that cost basis go to zero, then every payout would be taxed at a whatever rate, whatever tax advantage strategy your Covered Call ETF uses. The investor's burden: you must track your ACB, right? The legal responsibility is always you, the investor, right? This is critical for taxable accounts, not 401k or IRAs. Beware of drips, which complicate the math. It shouldn't be too complicated because it should be on your at the end of the year your 1099. Your brokerage should have calculated all of this for you. But if it didn't, then one, they suck as a brokerage. You should probably switch. And two, spend a little extra money to hire an accountant. It's not worth the headache, right? You might fill out something wrong and be like, oh my god, I owe, 20 grand when you probably owed like 2 grand. So please, be smart about this. And here's an example, right? You buy 100 shares at $50. The initial first buy is in January 15, 2025 for $5,000. And then pre-share adjusted cost basis is $50. And then next year, 2026, the amount goes down to 500 per share, $5. As you can see, it's going down by $500 as you're being paid out. So once this goes to zero, then you're gonna have to start calculating the taxes you're gonna start owing. So your 1099 should already show you. You'd be like, oh, I'm reaching zero. But how do we solve that? There is a way to solve that, right? You can always reinvest, and if your cost basis goes up, it delays, it defers it more. You shouldn't, you shouldn't be spending all of your monthly payout anyway. You got to treat it like a paycheck. Why would you spend everything if you don't need to? Personal preference. Personal financial preference. All right, part 4, the life cycle of a ROC investment. All right, the yield illusion, distortion of metrics. Distribution yield versus SEC yield, right? The distribution yield, TTM, trailing 12 month. The big number and adds, it's backward looking and includes all cash, which is dividend gains and ROC. And then we have the SEC yield, which is the standardized number, is forward looking and excludes ROC and capital gains, right? So the TTM is what is already basically has been finalized, is finalized up to this point for the last 12 months. So in a way, it is more accurate versus your SEC yield is more what the fund is trying to achieve, right? The gap is in your clue. The high distribution rate, but a low SEC yield is a direct proxy for the fund's reliance on ROC. The tax time bomb, selling your shares. The surprise example, right? Initial purchase $1,000. Your ROC received 10 years, 10,000 tax deferred. Final, you owed zero, and then you sell all the shares for $11,000. And then a taxable calculation, right? An uninformed investor might think the gain is only 1,000. The IRS calculates the actual gain. Taxable gain equals sales minus adjusted cost basis. Taxable gain equal $11,000 minus $0 equal $11,000, right? This is the intended strategy. You converted 10 years of income into one long term capital gain. Now, how do we solve that? Right? What happens when your cost basis hits zero? Right? When it hits zero, your cost basis cannot go negative. The tax treatment changes. Once your ACB is reduced to zero, the tax treatment of distribution fundamentally changes. Right? Any subsequent ROC, non-dividend, right, or no longer tax-free. They are treated as taxable capital gain in the year they are received. This is still favorable as is taxed at a lower term capital gain rate, not ordinary income. So you're gonna get taxed now, but it's still slightly towards more favorable and tax advantage. Okay, and then how do we solve that selling shares issue? Part 5, the ultimate tax strategy, ROC and generational wealth. The Great Eraser. Oh, I love that name, the Great Eraser. Stepped up basis. Your basis after 30 years, right? You receive ROC for decades, reducing your ACB to zero. the market value of your ETF is now $1.5 million, right? You have $1.5 million embedded in capital gains. Now, of course, this is that's if you have kids, you know. If you don't and you've been living your life, then you might either give away your shares, or you might pass away and the state might take your money, or I don't know at that point. This is where for those who don't have kids, then I guess shit out of luck. I don't know. I have some kids, right? Your heirs basis at inheritance. You pass away, your heir inherits the shares. The IRS steps up the cost basis to fair market value at $1.5 million. Your $1.5 million is embedded gain is legally and permanently erased. As of today, November, November this year, 2025, the IRS, this is the IRS. I don't know whoever's watching this video, maybe 6 months from now, a year from now, that might change. But a lot of people don't know about this, right? That's why one thing so good about ROC, you can do this. You can pass your shares, right? You can pass your entire portfolio to your heirs, to your son, daughter, whoever you want, right? And the IRS will you have an IRS tax rate as of what I said, November 2025, step up cost basis. The multi-decade estate strategy, right? Retirement, live on tax-free cash, ROC cash flow from your Covered Call ETF. Then step 2, boss basis reduction. Meticulously track your ACB. Your broker should do it. It reduces eventually hitting 0. Then you transfer, you pass away, and boom, your shares goes to your heir, and then your heir has to hopefully use some of that money to hire a good accountant, and they will file paperwork necessary for you. Tax erasure. Here's basis is stepped up to the current market value, or you know, if you want the heir sells your whoever you pass it on to, your heir sells the 1.5 million in shares with a 1.5 million basis, paying 0 in taxes. Imagine that. All right, scenario: parent sells versus heir sells, right? If you sell, right, parent sells 1 day before death, cost basis 0, taxable gain 1.5 million. Your tax bill is approximately, as of November 2025, it would be about 23.8%, almost 300, almost, let's just round it up to almost $400,000 that you're gonna be paying. Or B, you pass it on to your child. The parent dies and the child inherits and sells. 1.5 million step up basis. Taxable income 0. Tax bill 0. So the difference is about $350,000 to $400,000. Right? A lot of people don't mention these in the comments, right? A lot of people are like, oh my god, just giving you back your money. Oh my god, it's terrible. It's just you're being tricked. But when you research how you can effectively use ROC, you're like, oh my god, this is a generational. I can keep passing this on, and you know what? My kids can pass this on, and my kids can pass this on, right? I mean, this is just it's such a loophole that is so undervalued and underused. A lot of people just like, oh, it's just your money back. But hopefully you guys are watching this video to the end and actually doing a deep dive of your own and fact checking this, because you know, this is your money, and you worked so hard for it. You waited so long for it to compound. Why would you want to give it away to Uncle Sam? Is this legal? Yes. But, right, the current law, the strategy is 100% legal. It uses established explicit component of the U.S. Internal Revenue Code, regulatory focus. The IRS is concerned with correct basis tracking. Again, your brokerage should be tracking it for you. The SEC is concerned that the funds do not mislead investors. Of course, calling ROC income. Again, you have to pick a good covered call ETF that isn't handing you your money back and destroying the NAV. The political risk. Step-off basis is frequently criticized as a loophole. This provision is politically fragile and could be eliminated. Okay. I believe there was discussion about it. I don't know if it was the previous administration or if President Trump is trying to eliminate it, but it is in a discussion. They were talking about trying to get rid of it, right? Potential changes: carry over basis. Here would inherit your $0 basis tax at death. Each state will actually pay the capital gains tax. So that's what they're. I believe it was under Biden they were trying to change this. Um, yeah, they were a lot of rich people were using this, right? A lot of wealthy people were actually using this strategy, and Biden was trying to get rid of that. But as of November 2025, we are still good. And that's the end of it. Subscribe, like, comment, enjoy this deep dive. Let me know your thoughts. And again, this presentation is for informational purposes only and does not constitute tax or financial advice. I am not a tax or financial professional. All right, please consult a qualified professional to build a strategy that fits your financial goals. Okay, from my deep dive, this fits my financial goals, and I plan on passing it down for as long as I can, and hopefully, my kids learn about, if hopefully my kids still have this tax advantage um benefit, and they can pass it on. So again, rock is not a bad thing. Like all you see online, on Reddit, on Twitter, on the YouTube comments, it just shows their ignorance, that they don't understand how to effectively and efficiently use rock, or choosing a good, solid, higher quality covered call ETF that uses rock for its intended purposes. Thank you for watching the video, guys, and let me know if you like the video.